Hi everyone, we are going to be looking at accrued expenses, and this is going to be part 8 of analyzing business transaction. Okay, so I'm at the university library, and if you guys hear students talking in the background, sorry about that, excuse them. Okay, so the difference between ordinary and extraordinary is that little extra. So that's Jimmy Johnson, he's a football player. Okay, so accrued expenses, right? So expense incurred but not yet paid or recorded at the statement date are called accrued expense. Interest, tax, utilities, and salaries are common examples of accrued expenses. A company makes adjustments for accrued expenses to record obligations that exist at the balance sheet date and to recognize the expense that applies to the current accounting period. So prior to adjustment, both liabilities and expenses are understated. Therefore, as shown in the illustration, an adjustment entry for accrued expense result in an increase in debit to expense account and an increase in credit to a liability account. Okay, so accrued interest. Sierra Corporation signs a 3-month note payables in the amount of $5,000 on October 1st. The note requires Sierra to pay interest at an annual rate of 12%. So the amount interest recorded is determined by 3 factors. 1, the face value of the note, and 2, the interest rates, which has always expressed as an annual rate. And 3rd, the length of time the note is outstanding. So for Sierra, the total interest due on the $5,000 note at its maturity date is 3 months in the future is $150, right? So it's $50 for 1 month. So the formula for computing interest and its application for Sierra of month of October. Okay, so tip for computing interest, we express the time period as fractions of a year. Okay. So the accrued of the interest at October 31st increase a liability account, right? So the liability account would be interest payables. It's also decreased stockholders' equity by increasing our expense account, which is our expense, interest expense. Okay. So our interest expense shows the interest charges for the month of October. The interest payable shows the amount of interest the company owes at the statement date. So Sierra will not pay interest until the note comes due at the end of 3 months. And the company uses interest payable account instead of crediting the notes payable to disclose the 2 different types of obligation. So the interest and the principal in the accounts and statements. Okay, so without this adjustment entries, liabilities and interest expense are understated and not and net income. It will be always stated, okay, for equity. So right here are accrued salary. Okay, so company pays for some type of expense such as employee salaries and wages. So after the service have been performed, Sierra pays salaries on October 26th for its employees for 2 weeks of work. And then we got the next payment of salary will not occur until November 9th. So here's our illustration. So we have 3 days left remaining in October that we have to account for. Okay, so right here we got October 31st, right? So the salary for the 3 days represent an accrued expense and the related liabilities. Okay, so the employees receive their salaries for 5 days. Okay, so that's 2,000, and then we got, so it's basically $400 a day. And what we need to adjust is the $1,200 for the accrued expense. Okay, so with this accrued increase, a liability, salary, and wage payable. So this will also decrease our equity, and then by increasing our expense account. So we gotta look at salaries and wages expense. Okay, so right here, these adjustments and the balance is in the salary and wages expenses, 5,200. Okay, because we added the adjustments there for $1,200. And then, so the employees worked 13 days in October after beginning work on October 15th, right? So now the adjustment of salaries and wages of $1,200 is the amount of liability for Sarah's, what Sarah owes as October 31st. So without the adjustment for the salaries, our expenses are understated, okay, and liabilities understated. So take a look at that. Okay, so right here, Sarah pays a salary every 2 weeks. So we see that the next payable date is November 9th. So when the company pays again a total salary of $4,000, so you see that the payments consisted of the adjusted $1,200 for salary and wages payable, and October 31st plus the 28 of salaries and wages expense for November. Okay, so that's 7 working days. And then Sarah makes the following entries for November 9th. Okay, take a look at that. So this entry eliminates the liability for Sarah's wages payable, and Sarah records in October 31st adjustment entry. So it records the proper amount of salary and wages expense, and then the period between November 1st and 9th. So just a quick summary of the accounting for accrued expenses. Okay, so accounting for accrued expenses, and we got examples right here. Reason for adjustments, then the adjustments before, accounts for before adjustments, and then adjustment entries. All right, so example, we want interest, rents, and salary, right? So those are examples of our accrued expenses. And then why we want to adjust them, because expenses have been incurred but not yet paid in cash or recorded. And then if this is the accounts before adjustments, right? So our accounts would be understated, expense and liability would be understated before adjustments. And then when we do adjustment entries, what we do is we debit expense, and then we credit liability. All right, so you guys, if you guys want to take a look at the whole thing again, this is pretty easy and fast. Okay, so thank you. Bye.